Most companies treat a crisis like a temporary speed bump, assuming the answer is to double down on sales. But when a business is losing cash, applying a standard growth strategy usually just accelerates the collapse. Executive ego is frequently the primary barrier to survival. Denial of financial reality prevents a leader from making the specific, difficult calls required to stop the slide before the bank account hits zero. Founders often wait for a market recovery or hope that old clients will return on their own. This reliance on a miracle paralyzes decision-making while the remaining cash drains away day by day. Survival requires leadership to set aside their pride and accept the numbers as they are. You have to move past the denial phase and immediately execute a turnaround strategy. Companies often fail silently while still showing a paper profit. This chart illustrates the primary death signal: 2 consecutive quarters of negative operating cash flow. If you spend more to run the business than you bring in, you're on a countdown. You'll see secondary signals too. Your liquidity gets trapped in rising inventory levels, and top talent leaves as they see structural cracks. Recognizing any 3 of these signals means you have to pull the emergency brake. There is no middle ground. You must move into the 3-stage turnaround framework. Phase 1 is the triage stage. In a crisis, cash is the only metric that matters. Accounting profits are useless if you cannot cover tomorrow's payroll or keep the electricity on. You have to generate liquidity immediately. This involves freezing all discretionary spending, renegotiating terms to delay payments, and liquidating any asset that can be turned into fast cash. Take Siam Flavor, a chain that grew to 20 branches in 2 years. When the economy dipped, sales plummeted. They had massive overhead and 30 days of cash left. The CEO acted immediately. They halted bonuses and pushed supplier payments to 60 days, buying a few extra weeks of life. They also had to generate cash from what they already owned. They took raw ingredients from their warehouses and sold them as cheap lunchboxes on the street. It wasn't prestigious, but it turned idle inventory into immediate cash. Phase 1 doesn't solve the underlying problem. It simply stops the immediate hemorrhaging so the CEO has enough time to perform the necessary surgery. Phase 2 is retrenchment. This is the moment you admit the company's current structure is too large for the revenue it can realistically generate in the current market. You have to surgically remove the parts of the business that don't work. That means selling off losing assets, exiting toxic contracts, and restructuring your debt to match your new size. At Siam Flavor, data showed 8 of 20 branches were chronically unprofitable. These locations were siphoning resources from the 12 healthy restaurants making money. The CEO closed those 8 branches immediately. They paid penalties to break leases and walked away, allowing the profitable core to breathe. This stage involves layoffs, which is the hardest part of the process. You have to execute them with total transparency and fairness. Treating people with respect during a downsizing is the only way to maintain the morale of the staff who remain. Removing a significant portion of your own company is painful, but it is the only way to reset the financial baseline and save the organization from total liquidation. Once the company is stable, you enter the 3rd phase, the return to growth. But you cannot simply go back to the old model, the one that brought the company to the edge of failure in the first place. This is where you find a new way to operate. You pivot the business to ensure that future cash flows are more predictable and that the company is less vulnerable to the same shocks. Siam Flavor didn't go back to expensive malls. Instead, they moved their remaining capital into low-cost cloud kitchens. These units focused entirely on delivery, cutting out the high rent and service staff costs of their old model. This pivot converted a fragile, bloated chain into a profitable, asset-light business for the current market. They were smaller, but they were finally sustainable. Leading a turnaround requires making the difficult, often unpopular decisions that protect the majority. It is the CEO's responsibility to ensure the organization lives to fight another day. Surviving a near-death experience forces an organization to shed every ounce of waste. The resulting company is disciplined, focused, and equipped with a perspective that only comes from staring down bankruptcy. Once the business is back from the brink, the next priority is building a system to monitor for these risks before they become crises. Next time, we'll look at how to build that radar in our session on strategy review and control.